I've gotten funded over $4 million in my entire trading career, and every single trade that I take is based off of liquidity. Liquidity is the most important thing when it comes to trading because every single trading strategy, does not matter what it is, liquidity is the most important concept when it comes to any trading strategy because it is the basis of every single move that happens in the market. Today, I'm going to break down to you how you can spot liquidity, what it is, and how you can use these liquidity sweeps to your advantage and become a profitable trader once and for all. Before learning about liquidity, almost every single trade that I took, I would enter and then it would stop me out and go in the direction that I expected it to. I lost thousands of dollars, I lost funded accounts, and I was just so confused about how the market moved in general until I found out about liquidity. So that's why I'm here recording this video, because if some of you guys are having these same issues, this is the video that's going to help clear it up for you once and for all so you can finally become profitable. Let's get into the video. So to properly understand what liquidity is, we need to go over a few concepts first, right? Now, the first concept is going to be swing highs and swing lows. How do we know what they are? Why do they work the way they do? And this is what you're going to want to focus on. You want to focus on a pattern that looks something like this, where you have a high and then a lower high and then a lower high surrounding that first high, right? And then vice versa for the lows, you want to look for a low that has two higher lows surrounding it, just like this. Now, when you see this exact formation where you have a low or a high that is surrounded by lower highs or higher lows, that is how you know that you have a swing point. And to understand why they work the way they do, you have to also understand how retail traders operate. So pretend like you're going to take a short trade here. More than likely, wherever you're going to place your stop loss is going to be at this high, right? And then you go ahead and target, whatever low that you have there. And then vice versa for the long position, you're going to want a long, and then you want your stop loss to be at this low, right? And then you go ahead and target the highs. And that is the entire reason why these work the way they do, because traders have their stop losses at the high or at the low. And that is what liquidity refers to, is the set of orders that are either stop losses or buy limits or sell limits, whatever it might be. It refers to the set of orders that sit at those highs and lows. Now, before any major move takes place in the market, there is always a liquidity sweep, right? There has to be a sweep of liquidity in order for the market to proceed in one direction or the other. Think about it for just a second. If market was to push up higher, we would need to take those orders, those stop loss orders that are sitting lower, in order for us to go higher. Otherwise, everybody would just make money, and that is simply not possible. So if we take a look at this range right here, from the high to the low, there are going to be two significant points that we're going to look at. Number one is going to be the swing high up here, right? This is still intact. And then it's going to be the swing low down here. Why do I select these? Because again, same thing goes back to the pattern. The high has two lower highs surrounding it, and the low has two higher lows surrounding it. So these are going to be our swing points, the high and the low of the range. Now, essentially, all we're waiting for is for either the high or the low to get taken to trade the opposite side, because that's how we're going to get our draw on liquidity. Now, you can see right here, price comes down and takes this low out. At this point, once this happens, is where we would want to start looking for our longs. And you guys can see exactly how price reacts once we take those lows out. Now, you can see throughout this range, there are several other swing highs and swing lows that are formed. Now, not only do we have a new one that gets formed right here, we also have a swing high here, and we have another swing high up here. So these become our targets. We form a swing low down here as well. And you can see once again, liquidity has been taken, and we start to make a move back to the upside. We then go ahead and take both the highs out, and we now have a new swing high that gets formed, right? So now we are watching this. This is going to be the new swing low that forms. And you can see clearly, market makes a huge move up right after we take this swing low out. Now, this is one of the easiest ways to properly gauge order flow, because you can see that the highs are getting taken and market is continuing through, and the lows are getting taken and we immediately wick off of them. So we had the low that was taken right here, which pretty much set off this entire move. We had another swing low that got taken right here, and then we have another swing low that gets taken right here. And you can see how price reacts to the lows as opposed to the highs. Whenever we break through the highs, we get some closures above, and we have some structure that gets built, as opposed to just the liquidity sweep that we get down here. Now, because I just mentioned the word sweep, let me just cover these two examples real quick, and you guys are going to see the difference between a sweep and an actual breakout with displacement. You guys look at this range, all you're going to see is market sweeping through the highs and then rejecting back down. We get through the lows and we buy back up, and it is vice versa throughout the entirety of this little range right here. Now, the key difference between this structure over here to the left and the structure over here to the right is that we have a direction. It's not that we don't have sweeps, we have a clear direction in price. So whenever market breaks through the highs, we are starting to get some structure that builds up. But when it goes through the lows, it buys right back up. So you guys can see, once we get through the highs, we have some structure that gets built up here, as opposed to whenever we get through the lows, immediate sweep and a big push higher. So very, very clear differences between these two. This is something that you generally don't want to trade and you want to stay away from. And this is something that is very tradable and you have a clear direction. Now, when you see a chart that looks similar to this, where you have a big move and then a leg of consolidation, you're most likely going to see a manipulation move to the downside and then a move back up. So what do I mean by that exactly? You're going to want to identify those swing points that we talked about earlier, and you're going to want to use those to take some longs. Now, structure is already clearly bullish. We are making higher highs and higher lows. So all we need is one lower low where we have a liquidity sweep, and then we can start looking for our longs. Because remember, in order for another leg higher to take place here, we need to see a liquidity sweep. So the first two swing lows that my eyes go to is going to be this one and the upper one right here. As far as the highs, we only have this up here, which ended up rejecting, and then we have the one directly above, which is going to be our draw on liquidity once the low gets taken. Now you guys can see right here, we are now cutting through these lows and we take the second low right here and immediately make a move higher. Once price has this exact signature, we're looking for the opposite side of the range, the intact swing point, which is going to be towards the highs. And there you go. Before you know it, we go and we take that out, and that is this trade complete. Inside of this range, we form more swing lows and swing highs. So these are going to be our new ones. We took this one already, so we remove that. And now we have this to work with. Let's see what happens here. We have the highs, we have the lows, and we take the high once again and start rejecting. You can see price does not reach down into these lows at all. Instead, we reverse and start pushing through the highs. And now we clearly know where liquidity is and where it was taken last, because all of these downside targets are intact and the upside targets are clearly all getting taken out. So at this point, once we've figured that out, all we're doing is we're looking for certain lows, swing lows, and we are just looking to long them. That is it, nothing else. Here's another example where we have a swing high and a swing low. Again, as far as liquidity goes, what we want to see is, will price come all the way down and test the liquidity down here, or is it going to just continue through these highs? If it continues through the highs and we start building some structure, we know that price is in an uptrend, and we want to strictly just focus on downside liquidity sweeps. All we want to do is we want to wait for a signature in price that is going to look something like this, where you have a low that gets created, the low that gets ran, and then we're going to take the long there. This is the exact signature in price you're looking for. So as far as the downside targets go, I have this low right here, which catches my eye. So let's see what happens when price comes down into that low. Again, right now you can clearly see that all of these swing highs are just getting ran and price is continuing higher and higher. And then what do we do right here? We have that signature in price where comes under this low, and then we start building some structure under a swing low. So now we are going to target these swing lows that we have back here. Again, you can clearly see how order flow changes, how we go from respecting the upside levels, and now we are clearly disrespecting them. You can see by this leg right here, we go up through the swing high and immediately reject back down, taking those again, and then we have a swing high right up here. Let's see how price reacts to that. And what do you know? We don't even reach into it, clearly showing us that we have a lot of bearish action here. We form another swing high right here. These are going to be equal highs. Let's see if those get taken. What do you know? Those get ran, an immediate push lower in price. Another swing high getting ran right here. And in the meantime, we are just creating these relative equal lows. Notice how price shifted from taking the lows and continuing higher to now we are taking highs and continuing lower. These moves are displacement moves. This is not just a wick back up. We are closing several candles showing that there's a lot of bearish price action and price is developing some bearish structure here. We come down through this low and we create yet another swing low right here. We have our swing high right there. So let's see if price can reach up into that swing high. Again, we refuse to go up into that swing high and we create another lower swing high. Now, again, this should be adding up. You can clearly see how we're creating lower lows, lower highs. What do we have here? You guys can see that swing high from earlier gets tagged and we get this immediate rejection back down. Price is now starting to come up and take these highs out. And then here's your signature in price. Once again, we start forming lows and breaking through said lows. Now you can see exactly where price gets this shift in liquidity, where we go from taking out the lows to now the lows are getting left intact and we are taking out the highs, right? Very, very clear to see. And now we just start targeting these previous highs that we had here that were left intact. So this would become a target right here. The upper one would become a target, and then this would be essentially a final target for this range. And anytime, again, whenever we come down through these lows is where you would be looking for longs. We have equal highs that get created right here with this previous high. So again, increases those probabilities for price to come up and get through these highs. Keep leaving these swing lows untouched. Here's your sweep, and then that would in turn be your entry, because remember, we have created some structure above this previous high that we broke, right? It's not like we broke and rejected right away. We closed several candles and created some structure above right there. And there you go. Price makes a very clean move straight through the highs. We leave another swing low right here. So this would be yet another buying opportunity. And you can see price goes through the lows, sweeps, and goes straight up into the highs. Now, some levels that are going to hold more weight than most when it comes to liquidity are going to be things like previous session high, previous week high, previous day high, previous month high, etc. And not just the highs, but also the lows. Now, you guys can see here we're on a daily chart. And you can see we leave the same exact swing points. And you can see how previous day low here holds price and makes a nice push higher. And doing the same exact thing that we did on the lower time frame, we're going to use these swing points as our targets. And then each time you have a daily candle, the high and the low of that candle becomes a big liquidity level. So we have this candle here. We're going to simply mark out the daily high, the daily low, and then we can go down into the lower time frames and see how the daily played out. So the following day has just opened up. Now we can see how this day plays out. Does it take liquidity at the highs? Does it take it at the lows? Where are the swing points being formed and what exactly is going on? So obviously we have the PDL, which is going to be our major liquidity level. And you guys can see right now, price is just consolidating for the most part. We start making this move higher, and what do we see? We see price take this swing point right here and immediately reverse, right? As opposed to what it was doing previously, where whenever we would take a swing point, we would continue higher and close these candles above, leaving the lower levels intact. The clear switch here happens right there when we go and take the high and immediately reject. And now we are starting to target these lows that we had left previously. Market opens up right here, so you can see a lot of volatility. The low got swept right here. We created new swing lows, and now we have this swing high. So let's see what market does right here inside of this range. We sweep the high and immediate rejection back down. Again, leaving more swing lows intact. And then what we see happen right here, price is going straight through these swing lows. This is showing a lot of strength towards the seller's side. Now, all these swing lows that we had inside of this range have been taken. So the only ones left are going to be these overnight lows that we created in this consolidation and then previous day low. We have this high that we'll use as a swing point for the upside. We create equal highs and leave those right here. That is going to act as a magnet in the future. We take that magnet out and price continues lower once again. And there you go. There's your low of day, the PDL getting taken. Now at this point, your daily objective is essentially complete. But if there's going to be a reversal, this is where we would be looking for it to happen. So you can see price goes and sweeps this low, and now we are starting to push up into the upside. If we go ahead and take this high out and we start building some structure above, that means we're going to make a push back above the previous day low. There you go. We're through the high and we're closing several candles above. That means we are now building some bullish structure. We have a bunch of these highs that we can use. And at this point, any swing low that gets made, we're going to want to take some longs or look for some long entries once those swing lows get taken. So here's the nearest one. You can see how that reacts. We go through and then right back up, leaving some more swing highs for us. Again, just look at the reactions between these lows and then the highs, right? Clearly, we're closing several candles above the highs and prices refusing to go down and take these lows. Shows a lot of strength here. All the highs are still intact, all the lows are still getting swept, and so we continue on with the bullish structure. Here's another low getting taken. This is another place where we would want to potentially look for some longs, and the next thing you know, market opens up and goes straight to the upside, taking out all of these swing points that we previously had plotted out. The final swing point is going to be up here, which is going to be the high of the range. That is the previous day high, and before you know it, that gets taken, and there is another high getting taken right there. Now, if this is something that you think is going to help you out in your trading, make sure you guys subscribe to this channel. I'm going to be posting a lot more videos similar to this, breaking down these concepts in the best way that I can for you guys, and I'll see you in the next video.